I think we're good to go, Mel.
I'm just waiting for everyone all the attendees to sign in. Good morning and welcome to the third of the PFA's three-part learning series, Raising Capital and Deploying Capital in a Pandemic. I'm Melissa Kingham, Vice President of the PFA and Executive Director at Haben Property Fund. I will be the moderator for today's session. I begin today by acknowledging that we are hosting this webinar from the lands of the Gadigal people of the Eora Nation. The PFA also acknowledges the traditional custodians of the various lands on which you all work today. We pay our respects to elders past, present and emerging, and extend that respect to Aboriginal and Torres Strait Islander peoples here today. In this session, you will hear from Ben Harrop from Centuria, Steve Bennett from Charter Hall, and Mark Pratt from Australian Unity. There will also be a few poll questions throughout the session to gauge current market sentiment and our participants' views. We thank Centuria, who are providing the platform and logistics to run today's session. Before I introduce you to our first speaker, let's have our first poll. It looks at liquidity risk premiums. What is the liquidity risk premium for investors expecting to earn from investing in unlisted direct commercial property compared to listed commercial property? Please select your answer. While we're waiting for the answers to come in, I'll introduce to you our first speaker. Our first speaker today is Ben Harrop, Head of Distribution with Centuria. Ben is a seasoned sales leader within the wealth management and real estate markets. His specialist and experienced advisor and investor teams work closely with institutional investors, family offices, blue chip advisors, and high net worth individuals. Centuria, via its strong capabilities across listed and unlisted real estate, is a market leader in assisting clients solve their capital and income requirements. Today, Ben will be discussing capital raising through advisor channels. But before I hand over to Ben, the results from our first poll are in. Do we have the results? Interesting. You would expect investors to be seeking a premium for liquidity. That's good to see. Over to you, Ben.
Yeah, thanks, Mel. And look, that poll gives some insight, I think, between the listed and unlisted markets. And I'm going to be talking about financial advisor sector today. And they're an area where I think there's a bit of education needed to understand that risk premium and what's associated with it. So I'm really pleased to be talking about it today. I think we've got about 5 minutes and we've got sort of each of us presenting and then a Q&A at the back, so there's plenty of opportunity for questions. But look, I'm just going to give you a quick update on what we've been doing at Centuria, a little bit about the advice industry and the challenges they've been facing into over the pandemic and prior, and some ideas and thoughts about what we've done over the last 18 months during the pandemic to, I think, be successful in raising equity out of a particularly challenging market being the advisor community. So a little bit about Centuria. Look, you probably all know Centuria, but look, just a bit of an update. We've been pretty busy during the pandemic. We chose to keep busy. We're all back in the office now safely, which is great. But look, we've acquired 3 businesses in the last 18 months: Augusta in New Zealand, Prime West in WA, and a 50% stake in Bass Capital, which is a real estate debt fund. So we've gone from office industrial healthcare to now include agriculture, large format retail, daily needs retail, real estate debt funds. And in fact, the last 5 months, I told our CapTrans team, we've purchased 39 properties worth about 2.2 billion on behalf of investors. So we've been pretty busy. And I think an area which I'm pretty proud of, we put out an offer syndicate in the middle of the pandemic where we could see nobody. The Government Income Fund number 1, we raised $133 million in equity from mum and dads and financial advisors. And this last sector, financial advisors, is the area I'm going to discuss in a bit more detail. And I think for many in the industry, tapping into this sector is being difficult. There's a lot of complexity about dealing with the advice channel, and often it's overlooked and people just look for the high net worths or family office only. So look, before I discuss the equity raising approach we took for unlisted funds, I'm just going to go through a little bit of the challenges advisors have been facing over not only the pandemic, but also over the 18 months and prior with structural reform. And look, we all remember that the Haben Royal Commission, and for my sins, I was part of that, and I wrote part of the piece for ANZ in the previous job. But look, the advice industry has fundamentally changed from where they were at, which is commission-based for many, into a world which is now more complex, more regulated, and higher to cost to serve. And a good example is advisors now have gone from 25,000 3 years ago to about 18,500, and forecasted to drop to 14,000, which is, you know, seismic shift in the industry. They've now got enshrined law with best interest duties. They've got FASIA, which is education standards. They've now got to be degree qualified by 2025. Dealer groups or AFSLs are now charging $50,000 and upwards to have a license to transact per annum. ASIC licensing fees, PI covers are going up. At the same time, trial commissions and grandfather trials were phased out in 2020. So the result is the cost of serve has gone up and complexity has gone up in the advice channel. Advisors are, you know, they'll charge about $3,000 a plan. They're now having to charge about $5,300 odd just to break even, which is expensive, and it makes it hard to access advice for many people. So a lot of advisors now are managing out their client base and looking at their tail their clients. So many advisors had 500-600 clients. They're having now to squash that down to about 100 to 120 advice relationships. And then throw in on the 5th of October, the DDO and TMD framework and the anti-hawking provisions. There's just been a massive structural shift in the industry. And what this means is, for us in the industry, we've got to go on the journey with the advisors. And the advisors are absolutely renovating their businesses. And they have to. And what they're looking at now is their cost to serve and their efficiency of providing advice. And they're pushing a lot back onto the product providers like Centuria and Charter Hall and AU about, so how can you make it more efficient to deal with this? The other area which we might talk about in the Q&A is about the rise of SMA structures, so separate managed accounts, and the challenge that faces for our industry. But advisors also are sticking to what they do very well, which is focusing on the pre-retiree and the post-retiree marketplace who can pay for advice. So all the above I ran through pretty quickly there. That's a huge amount of regulatory reform. It sounds pretty tough, and you sort of go, well, why would I bother transacting in this market? But I'd say right now, and for my sins, I was an advisor a long time ago, early in my career, but advisors now have greater flexibility to make investment choice than they've ever had. And the clients which they are retaining, I think they're in the stronger financial position they've ever been. And they've got a lot of liquidity in their books, a lot of downsizing. They're selling their family homes, they're seeing a lot of cash, and they're going, where do I deploy that cash? And frankly, the TD strategy you're putting into TDs making 5% returns are gone. You're getting 10 basis points to 1% if best. So I think right now, the unlisted property market, through indexation of rents, the inflation hedge we have, and the lower volatility in the listed markets, we've probably never been in a strong position to talk to advisors about what we can do to solve a lot of their needs. But I come back down to, how do you get flows, or how do you engage with this sector? And we talk about high yields, and we see a lot of advertising, big high level yields up front, and performance, and they're very important, don't get me wrong, but you've got to consider the elements you deal with within the advice industry. So you've got to have relationships with asset consultants, researchers, platforms. You've got AFSL dealer groups before you even get to talk to a financial advisor. So there's a lot of engagement you need to do to get any kind of flows out of that sector. And look, at Centuria, we get about 60% of our flows from the advice channel, and the remainder from direct and institutional. So we're heavily weighted to this area, which a lot of people think we're more direct and non-advised, but we're actually not. We've got a national team who focus and understand the products, but more importantly, the team members really understand the advice process. And I think for those who are looking to raise equity from this channel, you've really got to understand, where does your product sit in the advice solution? So many times you go in there and talk to an advisor about a product, on their list of worry, that's the end of it. They really understand, I've got a yield issue to deal with, I've got clients worrying about inflation, how can you solve a problem for me? So that's really the way we look at engagement advisors, which it's sort of selling, but it's sort of not. It's really about the engagement and solution-based approach. But if I look really down to what happened during the pandemic from our point of view, look, we took a view at the start to say, look, it's uncertain, we're not sure where this will head, and it's turned out to be financially okay for many in the community, but we said we want to be a business partner with the advisor practices through this time of uncertainty. We understand the clients are worried, they're looking for leadership. So what did we do? And I've just jotted down a few points here. I'm pretty aware about time, but we went on the front foot, and I think this is a good point about over communication. So we took an approach where traditionally we would do face-to-face meetings with advisors and maybe once in a while do a presentation. But we said, look, advisors need a menu approach. So we gave them choice. We said we did webinars, we did a lot of emails, we did video EDMs, so we'd send out, they could look at their own time. We did SMSs. We gave them a smorgasbord of choice around education and on markets and products, and so they could choose the most efficient way to engage with us. At the same time, with the traditional get close to our clients, I think my team in the last 4 months has made about 3,900 calls out to our clients. So we get in the front foot, we stay in constant communication with them. But that's okay, you can do all that stuff, but I think the next thing is about ease of use. So if advisors are worrying about their bottom line, how can we make it really simple to deal with this? And we call it frictionless transactions. So if they deal with us, it's simple, they don't need to worry about it. It takes a lot of that concern out from advisor. And so we just made sure whenever you do anything with us, we make it simple, even down to triaging questions. We took it away from our administration company and dealt with it ourselves. But it comes down to admin as well. We spend a lot of time and money in getting the best administration provider for our business. And that's really important because a lot of people are still on paper applications. And I think this is important. I think the paper apps approach, which is still out there with IMs, I think it's a Kodak film of today. You can't have a solution going forward which isn't online or not on a pathway to online. I think you got to take to the next level too, which is I've got my mobile phone. If you can't have everything on the mobile phone very quickly, you're going to lose clients and disengage not only advisors but also the end investors. I also think about product design. We were probably going into the pandemic a little bit inward focus on product design. So we now spend a lot of time talking to all the constituents, from end investors to advisors to researchers, consultants, to say, what are you looking for? And often you end up with a solution over here, but you've got to be able to deliver something which is practical. But look, that's where we really took an important step. And look, I'll share a little insight with you. A lot of dealer groups now, if you have gearing levels over 50%, the professional indemnity insurance will not allow them to invest in that product. So that, a lot of people don't realize that, what does it matter if you take it to 55 or 60? Yes, it does, because you'll take out a whole sector of the advice community. The other area is research. So look, research is important, and we seek out independent research on all our products, and some people do and some people don't in the industry, but look, there's some great providers, Lonsec and Core Property, who are well respected, and they're really, for many advisors, you've got to have that research to even consider investing in a product. Sales team, look, we have a face-to-face sales team which hasn't done much face-to-face, to be honest, the last 18 months, but we're finally getting out now. But I've taken an approach, and all the team, we strongly educate our team. So upskilling, understanding what the advice needs are is really important, because you've got to get there and solve the problem. So education and alignment to what the advisor needs. And I think there's a couple other points here I think are really important is people have direct solutions, but you've got to have a really strong platform solution. So what I mean by that is you've got to engage with the hubs, the networks, the Macquaries, the BTs, and they're expensive. To get on those platforms is not cheap. There's a long process to get on them, but once you get on them, it means advisors can deal with you very, very efficiently rather than directly. Again, giving them choice.
So Ben,
and the last
Ben,
is around.
Ben, can I just ask a question there? We've just had a question come in, and it says, how will investment platforms need to adapt to include illiquid assets to form part of a client's integrated portfolio?
Yeah, that question sort of relates down to the SMA structures, which is it's sort of a complex area, but I'll speak pretty quickly. So the challenge is you have listed funds or managed funds, they sit happily on a platform, daily price, daily liquidity. And if you rebalance your portfolios, say an advisor wants to go from 10% to 15% in different asset class, so press a button now and it's simply done through the portfolios. Once you put on a, say, direct property fund with illiquidity, which it doesn't have, it might have quarterly liquidity or every 5 years, it's quite tough to manage that in a portfolio. So we talk about custodian, non-custodian held assets. So right now, platforms will add a product onto their menu, but often sits in isolation. And I think that's probably our biggest challenge right now in the industry. How do platforms evolve the technology to allow us to actually form part of a model portfolio? And that's an area
which doesn't
where
have daily pricing, yes.
That's right. So, but increasingly, as advisors want to go back to the cost of serve, advisors are now charging more, like 5,000 is a minimum entry. Many planners are probably charging 5,000 to 10,000 a year. And the clients are looking for not only their core portfolios, but they're looking for private equity. They're looking for real estate funds. They're looking for private debt solutions, which are traditionally illiquid assets, and they're not easily put into model portfolios. So I think that's probably our area where as an industry, we've got to work really closely with the platforms to say, the advisor is going to demand this product going forward and access. So how do you adapt your software, which is really expensive, to incorporate this change? So it's a really good question to put that out there, and it's something we've really got to think through as an industry, but it's complex.
And I'll just let all the participants know, this is actually a live session, so we do have opportunity for people to ask questions. So I might just finish up there with your presentation, Ben. And before I introduce you to our second presenter, let's go to our next poll, which focuses on acquisitions in the property sector. Okay, what have been the two greatest challenges for you and your clients in acquiring commercial property during the pandemic? And while we're waiting for everyone to select their two greatest challenges, I'll introduce you to our second speaker today, who is Steve Bennett, Direct CEO, Charter Hall. Stephen oversees more than $8 billion of assets on behalf of self-managed superannuation funds, SIV clients, high net worth and direct investors, in addition to managing a team of property and fund management professionals who are responsible for unlisted property across all core real estate sectors. Steve's day-to-day responsibilities include overseeing asset management and tenancy matters, managing the financial structure of the funds, stakeholder communications, and raising new equity capital. Steve is going to discuss acquiring assets in a pandemic. However, before I hand over to Steve, let's have a look at the results from our second poll. Interesting to see the split across the 5 sectors, across the 5 challenges. We'll come back to that later, but Steve, over to you.
Thanks for that, Melissa. And those poll results actually don't surprise me. Equity, the world's awash with it to some extent. Money's never been cheaper. The debt side of things, other than a 6-month period between April last year and September, where we saw debt margins spike 50 to 60 basis points. And if you had a pandemic impacted asset, say a hotel, they're 100 basis points. What that survey clearly shows is that the greatest challenges for most people on this call has been around sourcing property and at the right pricing. So look, that's something I think I'm well positioned to talk to. In the 12 months to 30 June, Charter Hall acquired, gross transactions of $10.1 billion, split across $2.1 billion of sales or divestments and $8 billion of net acquisitions. There's over 130 separate deals, and when we count that, we count a portfolio deal just as one, not the underlying assets that go into it. So look, the first thing I would say is that you needed to adapt. what we did was we had strong convictions in particular sectors going into the pandemic, which were only strengthened. So industrial and logistics sectors, the Bunnings type of assets, the convenience retail, we had very strong conviction in them, and in effect, we went harder at those deals as we went through the pandemic. I think we benefited from some extent that a number of participants sat on the sidelines, quite understandable, until the pandemic impacts flowed through the market a little bit more. So in essence, we had a bit of a first mover advantage because we didn't slow down at all, even once the first lockdown kicked in this country. I think it was late March last year. The other thing that the pandemic really drove was the proliferation on a relative sense, so they're always a smaller part of the market, but of off-market transactions. So off-market transactions, for those who aren't aware, are ones that aren't advertised for sale. You typically go to one or two parties, and if you can agree terms, you can transact. So why did they increase in importance? Well, a number of people were gun shy. There was considerable risk with running a sale campaign on market, advertising costs, reputational issues. If your investors saw you selling an asset and you didn't sell it. So what we saw was a larger number of groups willing to engage in an off-market basis. And what are the key elements of success in an off-market strategy? And so it could be sale and leasebacks on a scalable way, or just generally off-market. Well, the first thing's around reputation. We've got a good reputation in the market that once you put Charter Hall into a due diligence or heads of agreement, which to be honest is just a preferential position, there's nothing legally binding generally at that time, we pretty much always complete on the deal. Big caveat, if things aren't what we were told up front, if there's environmental or the heads of agreement changes, then absolutely we'll pull out of the deal if things move. But if the deal is as we were told up front, we've got confidence in the equity and the balance sheet, and we complete. So the reason why that's important is you need to have the trust of the agency world and the vendors that if you put someone in DD, they're not going to come back at you with a price chip, which can be quite a short-sighted way of getting a better price. And you may get it on that transaction, but more often than not, over the medium to longer term, your reputation gets tarnished. The other thing I would say is that similar to what Ben was saying, how Centuria got people back in the office, that was a real point of difference. Without naming them, I can think of two groups in the property sector at the moment that manage over $10 billion that still don't have their teams back. That may work if you're doing a linear type deal or something straightforward, but I can tell you it doesn't work when you're coordinating a transaction team of over 12 people, you're talking to your debt providers, you're trying to do due diligence in a strained and difficult environment. And so for the groups that got their teams back together, could collaborate, and often to crunch things out in short time periods to get in that preferred position, I think if you had the teams together, it was generally a major point of advantage that a number of groups couldn't do. And finally, I think there's some things that I would suggest that organisations can benefit from in terms of acquiring assets. So things such as making decisions quickly, having buy-in from senior team members, so whether it's the group CEO or group CIO or fund managers, screening deals quickly. So we're a high conviction manager in terms of what we bid on. I forget the exact statistics, but we tend to get around 70% of the transactions that we go after. And that's because we have faith in them, we've already done the modelling, and we've already cut out a lot of the deals that we don't think suit our investment style or the mandates, or we've spoke to the tenant and we know that they may not be sticky. The other thing I would say is that having the resources. So we benefited from having experienced people on the ground, very helpful when borders shut and continue to open and close. So being able to rely on senior asset and property managers and transaction managers in the locations where the assets are being purchased was a huge help. And finally, having those strong relationships across all parts of the stakeholder group. So External agents, we treat them very well. We pay them what we say we will pay them. We don't adjust their pricing, and we pay them promptly. That's one of the keys to continually getting deal flow from them. The tenants we engage with, we do more sale and leasebacks than anyone else in the market. And finally, I would just say that to round it out, the point I said at the start around the reputation. So people have confidence that when they deal with Charter Hall, that what we do and what we say are in alignment and the same thing. So there are groups out there who people expect price chips from if they go into DD. And look, we just sold an asset to Centuria recently, a great asset. And part of the reason why we ultimately put them into DD is that the senior management teams at both companies know each other well, and we had a lot of confidence in their ability to complete. So it is a significant factor that does play into the discussion. But look, Melissa, I think that's a bit of an overview of how we successfully completed a very large pipeline of transactions in COVID, and very happy to take questions either now or later on.
I don't know if it's an unfair advantage having such a huge team with national exposure, but I'm sure many of our participants can relate to what you've raised today. I think resourcing is very important. And Steve, I really appreciate your contribution today. I do know that there's a question that has come in. It says, let me read it. Have investors adjusted their return expectations enough given the record low interest rates and cap rate compression across sectors?
Look, have they adjusted enough? They've definitely adjusted expectations. When I started my career, it was an 8% distribution yield, which you needed to have to get people's interest. It's definitely come off. The point I always highlight when raised by an investor or an advisor is that we want to continue to stay disciplined, play at the quality end. And if that means chasing the institutional assets that have tighter cap rates and
seem to be losing Steve there. Steve, we seem to be losing you. I might move to our third poll today, which focuses on launching new funds. We can have the third poll up. How are you and your clients thinking about launching new unlisted funds in the next 12 months? Whilst we think about that and contemplate our answers, I'll introduce our third speaker today, who is Mark Pratt, Executive General Manager, Real Estate Investment with Australian Unity. Mark Pratt joined Australian Unity Investments in 2004 as Executive General Manager. Australian Unity Investments is responsible for the commercial management and growth of Australian Unity's property funds management and development businesses across healthcare and commercial property, social infrastructure and mortgages. In addition to his day job, Mark is currently the Vice Chairman of the Melbourne Racing Club. Prior to his current role, Mark was Australian Unity's Chief Operating Officer, responsible for supporting the growth of the overall business, together with the responsibility for finance, client service, IT and operational functions. Mark will bring together the capital raising and capital deploying process and discuss some of the key issues that he has seen over this period. Before we hear from Mark, let's have a look at the results of the third poll. Wow, that's very interesting, isn't it? Significantly high on positively, definitely will, which is interesting in light of the property and the sourcing property and price challenges that were raised earlier. Mark, I'll hand over to you.
Thanks, Melissa, and to my fellow presenters. High bar to meet for the next little bit, but I think a really interesting response to that poll. You know, especially as in property markets where we have seen the benefit of very low interest rates over the past period and a lot of money sloshing around the system. I do think the challenge of increasing interest rates over the next little bit is going to be something that is going to be very interesting to see how it plays out, especially as the market continues to have this very sort of strong focus on long WALE properties. Look, Australian Unity, we're a business that's been built off the back of retail, direct and high net worth investors over the journey. As Melissa said, we run businesses across healthcare, social infrastructure, commercial and mortgages, with a focus on advised and sort of direct investment. I think, in the last 12 months, we successfully raised over $600 million in equity across strategies right across those four businesses, and in very different ways. I think the one thing that we've seen over the last little bit, and I think it's become even more particular in the last 12 months, is this focus on raising capital for transactions. Our successful healthcare property trust is an open-ended vehicle. It's been going for over 20 years and is an example of a fund that we've really changed the way we have sought to raise equity and engage with advisors and investors in doing so. It was historically just a fund that was open for applications on platforms and the like, or just generally daily priced and the like. But we actually got to a point where capital flow, we couldn't keep up with transactions to match the equity flows that we had. So in the interest of investors, we closed that fund and new applications. We left it open for redemptions and the like in the liquidity facility that we offer. But since then, we have focused on effectively for-purpose raisings. And that enables us to engage with advisors and investors with a specific purpose of that raising, whether it be pre-positioning the balance sheet, funding of developments or acquisitions that we funded through debt and repaying those that enabled us to provide advisors and investors with a really clear story that they can then talk to, for advisors, their clients about and wrap their heads around. And I think we've seen that also in our debt business, where we run a contributory mortgage fund, which is in effect a series of small syndicates, individual loan syndicates, which does make it very easy to engage with investors, less so advisors, but certainly with investors, given the structure of the product, to enable them to make their own choice about a specific investment as opposed to a pooled piece. I think in the last 12 months, we have been very active in launching new strategies in the social infrastructure space. We raised capital for a development fund to convert the Australian Unity old head office to aged care and assisted living, which is a very exciting project. And we were able to introduce a new capital partner into that by bringing them the operating expertise together with our track record in demonstrating what we can do there. The other one, though, has been specialist disability accommodation, which focuses on providing high quality of living to members of the community who are in effect supported in that way through the NDIS. We started that fund about 18 months ago. In the middle of at the start of the pandemic, we'd done some pre-work towards the end of 2019, but we were looking to raise capital and settle it into the first half of 2020. All the while, trying to bring vendor and operating partners along with us, as we're a new participant in that industry, and also bringing equity partners into that. So this sort of very fluid tripartite sort of relationship to bring all of those things together in what, to be fair, is a very emerging sector. That certainly had its challenges, but I think, as both of the guys have touched on, transparency with clients, being really active and proactive and regular in your communication, not just with potential equity partners, but also as you are trying to match the timing of assets with capital. We did that fund with very little balance sheet from the headstock, certainly was one that required very active engagement and development of relationships and partnerships. Pleasingly, as you do the hard work in the first raise, if you do a good job, the second raise becomes easier, the third raise, the fourth raise, and we're certainly seeing that. And as we've recently launched a childcare strategy, and we're looking to make our first close on that fund at the end of this month. So the same sort of thing. I think the thing I'd just add to with these guys, it's very hard to do those things in a on-market transaction. To Steve's point, it's hard to get in any on-market transaction without Charter Hall overbidding you and knocking you out of the process. So that's sort of when we do the off-market piece, particularly in healthcare. I was talking to the fund manager of our healthcare REIT. 90% of our healthcare transactions, a lot of which are developed to own, so they are more development product, 90% of those have come through off-market pieces. So relationships, partnerships, stakeholder management on all sides, but in particular on tenant, vendor, operator pieces are absolutely crucial, especially in sort of some of these alternative asset classes where the operations of the business are much more embedded into the real estate. So, how things work for a hospital are embedded very, very much into the design. So that upfront engagement, we built a public hospital in Queensland, which we finished in October last year. And I think we did something like over 1,000 design sessions with the clinical staff from the Metro North, which is a public health hospital provider up there. So I think there's a bunch of things that are consistent in the things we've talked about here. I think that ongoing engagement and that transparency is absolutely key to be raising capital, but to access good quality, I suppose, product to match that capital with does require that sort of ongoing development and proactive sourcing of high quality partnerships on the other side as well. So Mel, I'm happy to take some questions. But I'll leave it there.
I'll just pick up a few things that you did say there. I think everyone's got a consistent theme in the fact that you're all specialists in your various categories. And I think in times of pandemic, having that specialist skill set and being a specialist in your area of expertise as well also is a big vote of confidence when investors are looking to make that investment. Steve, I'm actually going to hand over to you to give a right of response into relation to that Mark Pratt question about it's hard to buy on market when you're competing with Charter Hall, because I thought your due diligence and your property selection is a bit better than just paying the highest price.
Yeah, look, I'm not going to apologise to Mark if we can match the capital to the opportunity a bit better and price up assets for the right risk and return. But putting that aside, it is really about the expertise. So in all seriousness, when we are bidding on an asset, we've got a particular capital partner in mind. It may be an existing fund in the direct suite. It may be a new wholesale partnership. It may be a sovereign wealth fund. And importantly, the way they value assets and with our overlay of expertise and what we value assets at, it does give us a lot of confidence when we bid on something that we've already got an equity source across the group, and whether it's a listed vehicle to take it out. So on the expertise side, we've got at least 3 people in the transaction team in each of the core sectors. They're supported by fund managers, asset managers, CIOs, and transaction analysts. So the level of analysis that goes into pricing is phenomenal. I sit on the VAL committee. When we get VALs done, we get the benefit of seeing 1,400 assets. So you can quickly get a real good sense of the pricing that's happening in real time across the whole sector. So, but yeah, it's a fun place to be, and I think it's great that we've got the managers we do have here today presenting, because pre-GFC there was a number of managers who weren't focused on the end user and the investor. So having managers that is why I think the industry improved its reputation so dramatically over the last decade.
Thanks, Steve. There is a couple of questions that have come in. Just reviewing this one, I think this is for you, Ben. It says, given the increase in regulations, the massive decline in advisor numbers and the additional cost to access advice, is the advisor channel worth pursuing compared to institutional and direct?
Yeah, that's a good question, Mel. And look, I did touch on some of the forces impacting the area, but I look back, look, March 2020. I think everyone listening today, it was a pretty troubling time. You know, we were looking in the face of a pandemic. The markets were, well, listed markets had, property down 20–30%. It was a really difficult time, and here we are, 18 months later, where our biggest challenge right now is trying to find the assets at the right price, which will deliver a yield which the investors will find acceptable, which is an extraordinary turnaround of events in a small period of time. So I think each of their channels have their own strengths and weaknesses, but the advice channel, even though it's getting smaller in scale, sophistication is increasing, and just the scale of wealth in the advised clients. Unfortunately, it is expensive to get that advised clients, and there's a whole solution for people who can't afford to pay 5 to 10 as a minimum. But that wealth being generated is creating tremendous opportunities, I think, for our industry. So I think to have a good sustainable business, you've got to have your wholesale institutional plays in your big end of town. You need to have your family office, high net worth, absolutely, and investors. But advisors sectors cannot be ignored because they're controlling and increasingly controlling a larger amount of assets. And if you look at what happened in the US, increasing those sophisticated practices moved into family office. So when I was in the US a few years ago on a study tour, we had advisors $4 to $5 billion US they're managing on behalf of a couple of high net worths, and that's probably doubled, tripled given how markets have gone the last few years. So I'd say it's an area where you've got to focus in on them, but you've got to have understand it's complex. It can be at times expensive to engage. What I mean by that is just to get on platforms, the research, they all add them up. It's sometimes we go, look, the easy and cheap way to go is just I do an IM, I just target wholesale, and that's just the way I run my business. And that's great to start with, but you're going to get a natural barrier there to what you can get to. So anyway, long way of answering. Yes, it is worthwhile going, but there's some great challenge thematics going on there at the moment.
Mark, have you got something to add there as well? Thanks, Ben.
As I sort of said, we've been in business. We've grown up off the back of retail and advice investors. But I think it is becoming the thing I would say with the DDO regs and things like certainly cost of acquisition, cost to serve is going to get higher given ASIC disclosure requirements, all those sorts of things. So I think people have to go into it with their eyes wide open. I also think it's a really important piece of work for people to understand the particular, like liquidity is a very particular one where advisors, depending on which way they go through platforms, direct, researchers, that liquidity structure has to be quite particular for an advisor group, for an advisor channel vis-a-vis a direct to, self-funded retirees, self-directed, self-funded retirees, where our debt business is a very focused on that because the liquidity profile and the statement of advice process and the like does not lend itself necessarily to that channel. Then that's okay, right? Because we found a way that channel there is very effective. Look, it might be a little time consuming, but it's quite a high margin business for us as a manager. And given we've been doing it for 20 years, the retention of customers and of borrower clients makes it a really effective way to go through it. So I think the complexity of some of these markets, and Steve's comments on, every client has particular, whether it be cost of capital, duration of their investment, how they expect to exit, things which are different. Ongoing liquidity is particular to retail investors advised. There's a whole range of things, and I think it's not just as easy today as whacking an IM or a PDS around that and off you trot. It is something that increasingly I think managers, to be successful, have to do a bit of that segmentation, for want of a better term, and really understanding what market you're going to with what type of investment product that will dictate how successful we are, especially, given the amount of people who are looking to launch a new fund next year, right? I think it's a really important element for people to think about.
Thanks, Mark. On that point, I just know another question's come in around the DDO framework. I might hand this one over to you, Steve, but it says, has the new design and distribution framework and the associated target market determination requirements impacted the ability to raise equity?
Look, it's impacted it to the sense that more time and resources are being put in by the entire industry in meeting some new regulations. So that's without a doubt. Whether it's going to stop or reduce the equity inflows from certain channels, I think it's too soon to say, but the regulations only came in about 6 or 8 weeks ago. I don't expect it will. I think the groups that are raising the most money in this space have got well thought through target market determinations. There's a general level of consistency out there. I think the biggest risk is for probably some of the smaller operators who are potentially pushing the boundaries a little bit, particularly in terms of the liquidity aspect. So, look, I'd say that's an outlier. So I'm not expecting it to stop the equity at all. It's just unfortunately more cost being imposed on the industry.
And did you want to add something to that? Ben, did you want to add something to that?
Oh no, I think everyone on this call has been deeply involved for the last 6 months in getting DDO ready. Yeah, I just think it's just another layer, as Steve said, was about cost to serve. It just puts more complexity. Remember, this only applies for retail. If you're advised, it's not applicable. It's just for end investors. And I think the way it's framed, it's going to be tested, because you've got to determine a target market and what happens if you're in or out of that target market, you still invest. So there's lots of challenges, I think, will need to be clarified over the next 12 months. So again, another layer of regulation, which means ... more cost, which pushes the cost up for everybody. And I think our obligation is to provide solutions in an affordable, accessible way. So that remains always our challenge.
Thank you. There's a final question here, and I'll open it up and then you can select who's the best person to answer it. But it says, there's talk of ASIC raising the bar for wholesale sophisticated investors from the current 250K and 2.5 in assets to a much higher level. Will this impact the industry? Mark, I might throw that to you.
Look, I don't think it will. To be fair to it, I think it might, but I can't see it doing it. I think to some of Ben's points, there is more wealth as a rule out there at the moment, and I think some of that benchmark of 250,000 and 2.5 mil being a sophisticated client in today's perspective, where the median house price in Sydney or Melbourne is well and truly above some of that in most places, is sort of, I think it needs to be changed. I think that just becomes this tension point then around where your disclosure obligations and things are. I think the thing I would say, I think the real estate, the property funds management industry has a role to play in helping people get to their retirement. We are a more prominent source of tax effective distribution income than I think we ever have been, given that a lot of people coming into retirement have historically relied on the big four banks for dividends, companies like some of the traditional names like Telstra and AMP and different things like that, all of whom have had their ability to provide sustainable income but have challenged in a lot of ways more than this industry has over the past 3 or 4 or 5 years. So I think retail investors really value that. And I think, one of the trade-offs with potentially a higher cost at the start and to acquire is, if you do the right thing, you say what you're going to do, then you do what you say, retail investors will stick with you because they just love you, especially if it's tax effective, if you're doing a bit of development and the like. And I think that's a really important message for the broader property funds management industry that I think we all need to bear in mind. You know, just throwing an IM together, you know, and the like, you know, sometimes it seems a little bit easier, but generally those types of products have a different investment horizon in some respects to say our healthcare REIT, or, you know, some of the funds that either Ben or Centuria or Charter Hall run. So I think that'd just be my comment.
Okay. I might bring up, sorry, Stephen, did you want to say something?
Yeah, I'd just add that if you're going to do an IM product well, there's not a huge amount of difference in terms of the work involved. I can tell you the due diligence committee that goes through all our offer documents treats an IM exactly the same, where someone's gone through and signed off literally every statement in there, provided support to ensure it's factually true. So in most cases, it doesn't save you time, but it does, I guess, focus the end target equity source. So I think there's a place for both.
Agreed.
I might be a bit controversial, but I think the only challenge I'd see is if they lifted the bar up substantially. I know when a lot of businesses out there, when they're starting up, the cost to create a retail PDS, it's more expensive. So, so for a cost to access, I think for the industry at the moment, the IM structure works well as for some of the smaller businesses as they grow and develop through their time. So I think that'd be the only initial challenge. But I think Steve's right, and that the fact that, you know, we've got IMs out there that we go through the exact same process as retail. In fact, they look pretty similar, but not everyone's in the same boat. So I think it's something to watch. But as we're seeing product failures in the, you know, the wholesale sophisticated, it's putting a lot of pressure on that sector to do something. We've seen, I think last week, a fund manager raided, and it doesn't bode well across the industry. So I think that's anything. Maybe at some point there will be some move, and maybe they lift it up. But again, there's so much wealth out there. I'm not sure, you know, how much you lift it. Is it 10 million, or is it exclude the family house? Who knows? But I wouldn't be surprised in the next 3 to 5 years they do something. I'm just not sure how big a change it's going to make.
Yeah, I think coming back to the 3 points that the points you three of you have made, it comes down to your track record, I suppose, and your level of compliance. And really, if you're in funds management, and you've got an AFSL, whether you're retail or wholesale, you still have an obligation to work on with the benefit of the investor in mind. I'll launch our final poll question before we wrap up for today. And that question focuses on the current hurdles in launching new funds. So what are the biggest hurdles for you in launching a new fund? I'll just raise here, Steve, this question is slightly different to the second poll question we spoke of earlier, which focused on challenges during a pandemic. What do you think will be the biggest hurdle selected by our participants here?
Probably means I should go last in the answer, I think, Mel, given it's similar to Bennett.
All right, well, Mark, what do you think, if you're a betting man, what would you tip coming in as the biggest hurdle?
Look, I think it's a bit of, you know, for new businesses and the like, I think it's a bit of balance sheet support and asset values. Now you got to get your foot on things, and I think the ability, to some of Steve's point, we see this a bit, the ability to complete and is a really important impact for vendors. So I think they're probably the things for me, I would know.
And Ben, where do you see capital raising coming in?
The only thing I'd say is that they're all important, but with capital raising, I think there has been a huge amount of M&A in the listed markets. I think I saw it in the article. It's been the most active market in probably 15 years. So I'd just say there's a bit of fatigue from the investors and advisors being offered a lot of product. So I think that's something to keep an eye on, is if that velocity of offerings continues to rise, both in listed and unlisted, there's a lot of choice. So that might lead into sort of answering maybe a bit of cap raising, maybe a bit of crowding in the market.
Okay, Steve, here you go.
Probably more towards the asset values and competition. I think one of the challenges with launching any new product is you do have typically all the transaction costs up front, which haven't been amortized. If you've got an established fund, in many cases, that the stamp duty, DD costs have been fully amortised already. Traditionally, the vals lag a little bit just because of the way the valuation industry works. They don't typically move cap rates huge jumps. So, but look, I think there's merit in each of those four aspects depending on which part and how established you are as a fund manager.
Okay, well, let's have a look at the results and see who the winner is. There you go, asset values and competition, daylight. Wow.
I think Ben's just softening up Jason on saying how capital raising is getting difficult given the rolling distribution. Ben, I think that's hopefully you should forward your answer to him, I reckon.
Thanks, Mark.
Okay, well, that really wraps up our learning series for this year. I wanted to thank all our presenters and those who have participated in our various sessions throughout the year. A big thank you to all our facilitators, as well as especially to Centuria and to Alexandra and Dylan for hosting this session. We look forward to catching up with you again soon, and hopefully you joining the PFA Christmas Wine Masterclass event on the 9th of December. I think the best close for this session and this year would be keep calm and carry on investing. Thanks to all, and have a good afternoon.
All right.
Thanks, everyone.
Thanks, PFA. Thanks, Vincent.
Thank you.
Thank you.